Welcome to this comprehensive guide on understanding income statements. An income statement is one of the most important financial documents that reveals how profitable a business or individual venture truly is. By the end of this video, you'll be able to read and interpret profit and loss statements with confidence, enabling you to make better financial decisions whether you're running a business, investing, or simply managing your personal finances. An income statement is a financial report that shows a company's revenues, expenses, and profitability over a specific time period, such as a quarter or a year. The fundamental equation is simple: revenue minus expenses equals net income. This document goes by several names including profit and loss statement, often abbreviated as P&L, statement of operations, or statement of earnings. All these terms refer to the same essential financial report that measures business performance. Every income statement contains four key components. First, revenue, also called the top line, represents the total income from sales of goods or services. Second, cost of goods sold, or COGS, which covers the direct costs of producing those goods or services. Third, operating expenses, which are the costs of running the business day to day, like rent, salaries, and marketing. Finally, net income, known as the bottom line, is your final profit after deducting all expenses and taxes. Understanding these four components is essential to reading any income statement. Let's look at a practical example. Imagine ABC Company with $500,000 in revenue. After subtracting $200,000 in cost of goods sold, the gross profit is $300,000. Next, operating expenses of $150,000 are deducted, leaving an operating income of $150,000. Finally, after paying $30,000 in taxes, the net income is $120,000. This waterfall structure shows how revenue flows down to profit, with each expense reducing the total along the way. Revenue is the starting point of any income statement and represents all money coming into the business. There are two main types: operating revenue, which comes from your core business activities like selling products or services, and non-operating revenue, which includes income from secondary sources such as interest earned on savings or returns from investments. Revenue is called the top line because it appears first on the income statement. Growth in revenue is a strong indicator of business expansion and increasing market demand for your offerings. Cost of goods sold, or COGS, represents the direct costs of producing the goods or services you sell. This includes raw materials needed for production, direct labor costs for workers who create the product, manufacturing overhead like factory utilities, and shipping and freight expenses. The formula for gross profit is revenue minus COGS. Understanding COGS is crucial because it reveals production efficiency, shows whether your pricing strategy is working, indicates your profit margins, and helps identify opportunities to control costs and improve profitability. Operating expenses are all the costs required to run your business daily, excluding the cost of goods sold. These fall into three main categories. Administrative expenses include salaries, office rent, utilities, and insurance. Sales and marketing expenses cover advertising campaigns, promotional activities, sales commissions, and business travel. Other expenses include research and development, depreciation of assets, legal fees, and technology costs. Managing operating expenses effectively is key to maintaining healthy profit margins and ensuring long-term business sustainability. Net income is the final measure of profitability and is calculated by taking revenue, subtracting all expenses, and then deducting taxes. Alternatively, you can calculate it as operating income minus interest and taxes. This is why it's called the bottom line. It's the last number on the income statement. A positive net income means your company is profitable and generating value. A negative net income indicates a loss. Net income is also used to calculate other important metrics like earnings per share and return on investment, making it one of the most closely watched financial figures. Several profitability ratios help analyze financial health. Gross profit margin is calculated as gross profit divided by revenue, multiplied by 100. Operating margin is operating income divided by revenue, multiplied by 100. Net profit margin is net income divided by revenue, multiplied by 100. Return on sales is operating profit divided by revenue, multiplied by 100. These percentages reveal how efficiently a company converts revenue into profit at different stages, helping investors and managers compare performance across companies and industries. Mastering income statements empowers you to make informed business and investment decisions. Use income statements to track performance by monitoring revenue and expense trends over time. Identify issues by spotting inefficiencies and areas where costs can be reduced or revenue increased. Make better decisions using real financial data to guide strategic business choices. Whether you're an entrepreneur, investor, or simply interested in financial literacy, understanding income statements is an essential skill that will serve you well throughout your financial journey. Thank you for watching, and start applying these concepts to real financial statements today.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.